focus on Wall Street. Both Goldman Sachs and Bank of America beating revenue and earnings expectations this morning. Joining us right now is Rafferty Capital Markets equity research analyst Dick Bove, along with the CEO, President, and Chief Investment Officer of Creative Planning, Peter Mallouk, is with us. Good to see you, gentlemen. Thank you so much for joining us. Dick, good morning to you. Look, I got to give you a shout out. On your call earlier in the summer, said nobody's going to make any money from bank stocks this summer. You were exactly on point, and that's what's played out. What's your take on the earnings so far this morning?
Well, I think the earnings this morning are very mixed. I think that Bank of America clearly did not beat its earnings estimates, and Goldman Sachs played around with its compensation numbers once again and showed pretty bad revenues. So I would say that neither one of these companies showed themselves as being particularly strong. If you want to take a look at a strong bank, PNC on Friday, or Comerica, a regional bank in Dallas, both of those banks did extraordinarily well. So you can compare banks that did really well against companies which are not doing really well in terms of their comparisons.
Yeah, it seems to me, Dick, Bob Nardelli here, some of the smaller banks seem to have more agility and being able to fill the void that some of the larger banks, due to Dodd-Frank's, have been, kept out of the market a little bit. Is that kind of what you're seeing out there?
Well, it's part of it, obviously, but I think that the big banks are running into problems in terms of increasing their loan volume. And in this quarter, the thing that was so surprising and, let's say, shocking in terms of looking at these companies is their net interest margins went down quarter over quarter. Now, everybody who's been on television for the last 4 or 5 months, maybe the last 6 or 7 months, have argued that the increase in interest rates would result in a big increase in the net interest margins of the banks and that they would make a lot of money as a result. And it didn't happen.
Yeah.
And it didn't happen because, people are not suckers. They want some type of return for their money,
right,
and they're demanding it.
Well, now we are seeing rates move higher for the first time in a long time. Peter, what's your take on what we're seeing in terms of the backdrop here in the economy? Rates are moving higher. You're needing to allocate capital all around $27 billion in assets under management. How are you doing that?
We're still bullish on America, and we're really bullish overseas, where there's a little bit more value, I think. If you look at earnings overseas, you've got a higher dividend yield, you've got a lower PE ratio, there's a lot more upside. But in the United States, I don't think the market's overvalued because you've got rising rates, because the Fed sees a stronger economy because of declining unemployment. I think unemployment's the real story that's supporting everything, even more than the proposed tax cuts and who's president and everything else.
Well, does that continue, though, the rising rate environment, the very healthy job market that we've seen, given the lack of any movement on fiscal policy? Because, again, you're starting to get that sense that the Federal Reserve is saying, if we don't get something on the fiscal side, we're still standing ready with some loose monetary policy. Yeah, I got that sense from the minutes from the last meeting.
Well, I think for the last 9 years, despite very slow movement by the government on helping with anything, whether Republicans or Democrats, you've seen 9 straight years of declining unemployment. And you've seen slow growth because unemployment didn't drop rapidly, but it kept getting better. Well, now we're in full employment range, a number that when it was 4.9 during the elections, Trump said was a fake number, and today, it's 4.6. He says it's a real number, right? So when we look at this number, it's declining, and even though it's slowly, it's a very low number. When you have that, you have wage inflation. And so to me, even if we don't get all the tax policy, and I still think that we will, that's really what's driving the backdrop. And the Fed will always change course, no matter what they say. If you look historically, they will adjust. So they're not going to raise rates unless they see that they can do that without negatively impacting the economy.
So Dick, Bank of America CFO said that B of A's return on equity will improve as the bank returns capital to shareholders. What kind of capital to shareholders are we looking at in the next couple of months here? Go through the sector. Who's poised to raise their dividends?
Well, everybody's going to raise their dividend, and everybody's going to increase the stock buyback programs that they have in place. There are 10 banks, Citigroup, leading the charge, so to speak, who are going to pay more than 100% of their earnings out in dividends and stock buybacks. But think about this for a second. If a company reduces its capital in a rising interest rate environment, it is lowering the value of the business. It's reducing its ability to grow earnings. So the net effect is, what these companies are saying is, go buy my stock because we're going to get our ROEs up, we're going to do financial engineering, but the process that we're going to use to do that is to lower the value of the business. Also, you know, if I could mention the Federal Reserve for a second, you know, if you take a look at the Federal Reserve balance sheet, the way an analyst would look at it, that reserve balance sheet has lost over $400 billion in bank deposits. Banks have pulled deposits off the Federal Reserve balance sheet. The Fed has been scrambling like crazy to put back the $400 billion that they lost that the banks took off. If the banks keep pulling deposits off of the Federal Reserve balance sheet, they're going to tighten. It doesn't matter whether, you know, they want to loosen or not. They've got to replace the money that the banks are taking off the balance sheet. And as they do that, and as Jamie Dimon clearly indicated a couple of days ago, you'd have no idea what the impacts are going to be on the marketplace, on interest rates, and on the free flow of funds. So I think the analysis of the Federal Reserve has got to go beyond, you know, what these people are saying in these speeches. Take a look at the balance sheet. Take a look at what's happening to bank deposits on that balance sheet, and you got to be worried.
Sounds like you're worried about a sell-off coming, Dick.
Well, I mean, basically speaking, you know, if you're lowering the net value of a company, I don't see any reason to go out and buy the stock in that company. You know, you may financially engineer the stock so it looks really good, but the fact is you can't lower the capital in a rising interest rate environment and not harm the value of the company and harm the ability of that company to increase its earnings. And if people want to buy into that, I think they're making a big mistake.
Wow. All right. Well, that's important info that you just shared with us. Peter, real quick, you say you're putting money overseas. You like emerging markets like China, or?
We like the emerging markets index. I mean, if you look at most emerging market countries, the entire market capitalization in the entire country is less than Apple. So we're not really big on betting on one specific company. We use a broad index.
Do the index. What about Europe?
Same thing. We use VEA. We use a broad index there. And
on an exchange basis, does that have a big impact in some of the regulations that are being bantered around by the administration?
Well, I think that early on, when he was elected, when Trump was elected, there was a lot of concern. You saw overseas markets and emerging markets really take a big dip. As he's become focused on other things, people are less concerned.
Okay.
The markets are less concerned about regulations negatively impacting the trade.
What about Brexit negotiations that are going on right now between Great Britain and the European Union? Is that going to have a negative impact?
Well, I think this is a great reason to be indexed. Like, if you look when Brexit happened, you saw an immediate negative impact in the United Kingdom, but you saw it start to benefit countries like Germany pretty quickly. And so I think when you're broadly allocated, you're going to watch commerce move from one emerging market or international country to another.
And Dick, final question for you. Is there one bank that you would buy right here?
Well, I mean, today I'd go out and buy some Comerica. That company had blowout earnings, in my estimation, in the report that they had this morning. I'd buy PNC Financial. And actually, I do like Bank of America longer term, even though I'm not crazy about this quarterly result.
All right, we'll leave it there. Dick Bove, Peter Mallouk, great to see you both. Thank you, gentlemen.